The SEC actively looking into a proposal by President Trump to switch earnings reports from a quarterly to semi-annual basis. Joining us right now, first on CNBC to discuss this and so many other issues, is SEC Chairman Paul Atkins. Mr. Chairman, we appreciate you joining us. It is the issue of the week, if not much longer than that. A lot of CEOs in America and investors trying to understand this proposal and how you're thinking about it right now.
Well, thank you, Andrew. Thanks for having me on today. So this is, welcome that posting by the president, and have talked to him about it. And so you have to realize that right now, semi-annual reporting is no stranger to our markets. Our foreign private issuers do it right now, and it was actually the rule until 1970 when the SEC promulgated the whole concept of 10Qs. So there's been a lot of discussion over the past few years about how this quarterly reporting kind of emphasizes a short-term type of thinking, and I have heard anecdotally throughout my life about folks in the private with private firms and whatnot negotiating with public firms, and they say it's a great time to do it right before the end of a quarter or the end of the year, so because they can get better deals for themselves. So I think that for the sake of shareholders in public companies, the market can decide what the proper cadence is, and for companies who have debt issuances and things like that, I'm sure their banks will have something to say about it. But in principle, I think to propose change in what our rules are now, I think would be a good way forward, and then we'll consider that and move forward after that. So I welcome the president's putting this
Chair,
for discussion.
Chairman, speak to this issue. Clearly, it would be beneficial to the companies in terms of just the costs, the mind share, and attention that's oftentimes brought to bear if you're reporting quarterly. At least a week out of every quarter, 4 times a year. Most executives are focused on that. They're not focused on the day-to-day business. That's a cost even beyond the actual economic cost of putting together the quarterly numbers and everything else. The question becomes whether you think the public, especially the public shareholder, retail shareholder, that may not have access to all of the new data streams that professional investors have access to, need that information, need more information, and how you think about that. Because it is clear that the professional class of investor today can get satellite data, they can get credit card information, there's lots of inputs that they can be collecting throughout the year that have value that the retail investor may not have the same access to.
No, that's true. So, but people watch your show and others to get information, and so the dissemination of information is much more widespread than, say, back when I was a kid and I watched my father go through annual reports and proxy statements. So back when you actually could do that. Now I challenge people today. There's so much in these things and a lot of kind of CYA for litigation purposes. But if you look at the way people, even professionals, get their information, they don't necessarily get it from the 10Qs. They look for the earnings calls that the CEOs and CFOs of public companies do, and those tend to be things that people concentrate on. Those are very scripted sorts of things to make sure that everything, from the company's perspective, meshes with what their overall disclosure is. So I think it's a good time to look at the whole panoply of ways that people get information and how it's disseminated, and what's fit for purpose. I think that's what we're intending to do.
I'm curious whether you think that once you give companies choice effectively, whether some actually will continue with quarterly reports or might even move into some kind of monthly kind of program. I could see some companies move back, obviously, to a twice-a-year situation, but others who say to themselves, I want to keep this going, and maybe they can create more trust or value for their shareholders, and how you think about that.
Right. We have to remember who the boss is, and that's investors. And so the investors who will demand that sort of information at the cadence that's appropriate to what the company's doing and what it's up to. We have also the whole concept of an 8K, which is for certain types of events and material information that companies need to do that regardless of when the Qs fall. So that's an important concept as well. So we want to look at all of this. It's a good time to look at it. That since 1970, a long time ago, we've had the Qs. So let's take a look. There have been lots of complaints over the years about short-termism. So let's see what we can do to address it.
Chair, one other big topic that's come up just this week, and maybe even more broadly, has been, and we've discussed the idea of making private investments more accessible to the public investor class. Robinhood announced plans to create a fund, effectively, that would buy shares in private institutions that then public investors, retail investors, would be able to access. And I'm curious what you think about that. It will ultimately need your approval.
Yeah, well, I salute, again, the president issued an executive order to the Department of Labor and to us at the SEC to look into this. And there's been, again, discussion about this issue now for decades as to how public investors can make investments in private funds if they're not accredited investors and that sort of thing. So I think that with the way the markets have changed so much, the public markets in the last a few decades, we now have half the number of public companies as we did 30 years ago. And so, and look at the concentration of the S&P 500 into tech stocks and that sort of thing, the Magnificent Seven. So who's to say that normal investors who are investing through their 401ks and their IRAs should not be allowed to diversify and to go into investments that heretofore are only available to the wealthy and to big pension funds and things like that. There have to be proper guide rails around it. We can't go in and just fling open the gates. I think we need to make sure that that people have the whole protections of diversification. Liquidity is a big issue, valuation, those sorts of things. And then, we have evergreen funds. There have to be, some kind of payday where people, if they're in a termed type of thing going towards retirement, are not left holding a bag where they cannot have liquidity when they need it as they retire.
Well, I think you're referring to what I think is described these days as these semi-liquid instruments that folks are creating, this idea of buying a liquid assets, but trying to create liquid instruments to work with that. How do you get around that central issue, which is when they're working, it's great because there's liquidity. The problem is when they're not working, and it's typically all at once, there's not liquidity for anybody.
Yeah, well, so that's the idea of diversification, to put all your eggs in one basket. And also we have to, I think there's a lot of promise with the whole digitization and looking at alternatives to how does one judge and value securities in this particular marketplace. So there are different companies that are working on that to try to have a secondary market in some of these types of illiquid assets and to broaden that so that institutions around the world can tap into that and that there's more exchange of information.
Philosophically, how do you feel about disclosures, the current disclosures, which aren't much in terms of private companies, but as you move these private institutions and investments in private companies into the public sphere, whether you believe that fundamentally there should be more disclosure or at least a change in some of the disclosure rules, given that invariably when things like this happen, the charlatans arrive. I mean, every time we've seen, thinking of the SPACs, just even the past couple of years, when you get sort of quote-unquote innovation in the marketplace, it often comes with the twin of innovation, which is a good thing, is speculation. And it doesn't oftentimes, at least initially, work until hopefully certain things get fixed. But how can you get ahead of that?
Yeah, well, I won't cast aspersions on any particular type of product, but what I will say is that that if you look at the disclosure in the private markets, that's changed a lot over the last couple of decades, and what's in the public markets have converged for better or worse. The volume of information and that sort of thing, the protection against potential lawsuits. So what we're right now taking a look at for at least the public markets. starting to take a look, and we'll have proposals soon regarding looking again at all of the disclosures that are out there, how they have piled up, and how it's kind of a overload of information that is put on people, a lot of it repetitious, a lot of it boilerplate and things like that. So I think we have to remember that the reason why people don't want to be in a public company these days are really three things: the litigation that's out there, the huge cost of compliance with regulatory disclosure, and then finally some of the corporate governance issues that have arisen over the last few years that have distracted management from actually doing their job. So we're looking at all three of those areas, in the public markets, and then also at how normal investors can avail themselves of some of these other types of products.
Real quick on the governance side, because it is a big issue, I think, for businesses and investors. For a very long time, there was a view that the more democracy you could put around governance, the better. And now there's a view, I think, increasingly that sometimes that democracy is creating too much, quote unquote, noise, and which shareholders should have a voice and which shareholders shouldn't.
Yeah, well, so that's, a lot of that's up to the individual companies, and it has to do with state law. There have been good articles, I think, raising very good points in various publications here recently. So I commend those to your reading and to the audience's reading. But those are some of the issues that we will be looking at. There's been too much weaponization of the corporate governance structure in general. And so by politicized shareholder activists and things like that who have taken advantage of just basically lobbing in shareholder proposals that may not be the most germane to what the company's all about. And then you layer on top of that some of the asset managers that are out there that probably need to look more carefully at some of these things.
Chair Atkins, I want to thank you for joining us this morning. Appreciate it.
Thank you very much.
Thanks,
Andrew.